Quick overview of our swing trading. It'll probably benefit everybody. We have a number of swing trade approaches. In general, when we're thinking swing trades, we place that in a position between core trading and day trading. And we think about core trading as positions that are going to last like anywhere from 2 weeks. And day trading, obviously, intraday only. And so swing trades tend to be trades that last from 2 days, maybe to 10 days. So we're thinking 2 days to 10 days. And we can think of those three styles of trading, or those three time frames of trading, as separate and distinct bodies of knowledge that really have different purposes and different approaches and different time commitments and different objectives. And performance factors are going to be really different depending on which bucket that you're in. So when we think about the core, we think about things like the monthly asset allocation of blended monthly rebalancing. We can think about an even more relaxed approach, which is asset allocation with a balance between, say, stocks and bonds, or ETFs and bonds, with or without a market timing scheme, so that if you are in the bull market, you're just long and strong with some kind of blended mix that's appropriate. As you approach sideways or bear markets, you may take some of that money off the table as a way to reduce volatility and to prevent against total catastrophe. You might use something like the Brown Permanent Portfolio, which is a mix of short-term interest-generating bonds, long-term treasuries, gold, the S&P 500, for example, or total market index. And it just rebalances continuously, always in the market. So in the core, what you're really looking at is simply you're watching the corn grow. You're trying to plant the corn during the right season and just let it grow. Go fishing during fishing season, something like that. So you're not really trying to optimize, you're trying to get market returns. At the other end of the spectrum, on the intraday trade, what we're really doing, intraday trading, and we really don't talk that much about the swing trades that could be going on, because we're really managing the intraday bucket. And what we're trying to do there is eliminate the overnight risk in equities and take advantage of statistically valid patterns that take advantage of abnormal conditions and then play for either a continuation of the abnormality or a reversion to the mean. So in a nutshell, what that looks like is, if you had some kind of price action like this, and then you had some kind of threshold in which you would say this between those two prices is normal. What we're looking for is something like a move that goes out of normal and then comes into a relative range compression, which we would call in general a critical state. And then we think that critical state is either going to resolve itself back to the previous normal, so that's a reversion to the mean trade, or we would say there is some kind of underlying factors in the market that caused it to have that abnormal move that brought it down to this critical state, and then maybe that's just the first leg, and we might be expecting to see 2 or maybe 3 more legs as the market discovers whatever it was that was causing that problem. The other kind of day trade we get is when that range of normal compresses to such a narrow degree that you have an abnormal compression. And we think, well, that's so abnormal that that itself is a critical state. And then we play something like a bracket trade or a Z3P, where we're looking for the breakout in either direction. And we're actually ready for a fake 1 and go 2, or we're ready for that thing to continue to fail. So the day trading tends to be statistically based. We're not looking for deep-seated reasons for the price action to occur. Like, we're not trying to find some explanation that triggered it. We're just saying the price action itself is its own explanation. And what we're going to do is recognize when we have normal conditions and what we can do inside of normal conditions. Like inside of a normal condition, for example, you could play these kinds of moves, which I'm showing in the green, where it comes down to the boundary of normal, and then it reverses through the mean, and then goes to the far side of normal. And so you're just getting this kind of intraday channeling. And it may be that in that kind of a market, you can have small risk boxes like that at the boundary. And then what you said is, look, if that thing fails and goes this way, goes south, then it just violated the boundary of normal, and so I'm into my abnormal breakout move, and I only have to pay that tiny little risk. But if it works and it goes up from here, then I get a favorable reward to risk multiple. If it just goes to the other limit of normal, I might get 2 or 3 or 4R in that kind of case. And then when it gets to the far side, it's in another critical state where it's either going to revert back to the mean, or it itself might break out and become abnormal. So that in general represents the standard frame of mind that we adopt intraday for using statistics in our favor, not having a directional bias, but really taking a look at the market structure and looking for the different levels of support and resistance. So the resistance above, and then say support below, and then we're watching for that price action to come down and find support, hold, and then we trade it, and we're looking to get back to the first level of resistance. And if it starts to fail, we invoke the 2R battle drill and it wins. But if it continues, then we think it can get to the second level of resistance. And if that fails, we think we can do the 2R battle drill and get paid. Or if it gets to the third level of resistance and starts to fail, we can cash a really good trade. But then if it breaks out of those limits of normal resistance, that's when you really start getting that abnormal condition, which might represent that runaway freight train. And so we play that in both directions.
So here we are, folks. Just as I had promised in the other video, I wanted to show one of the secrets that we use. And this one in particular is the basic sniper entry. We had a trade going on earlier today where the price had met some criteria. We got what we call a kata 2. That's not what I'm illustrating here. Then we got a second position. And then when price had crossed, as represented by this moving regression line 10, it had crossed first the simple moving average 3, then it crossed the so first it crosses the simple moving average 3 in the magenta line there, the moving regression line 10, then crosses the spine of the dragon, which is a simple moving average 10, which also happens to be the midpoint of the Bollinger Band that we have set up specifically for our trading. When it crosses that, that's our second indicator. That also happens to be where we got out of the other trade. So we get out of that trade there. The third criteria is when we have a PSAR flip, which is a parabolic stop and reverse flip. At that point, we got in. Now the flip is here, but the candle is actually up here, so we got in right there. Price starts moving out nicely in our direction. That's great. It hesitated a little bit, so then we just get a kata 2 again, another pattern which I'm not really describing here. Moves out again, kind of hesitates a bit. Then get another kata 2. Then we get moving right along into the fourth position, which is part of another advanced technique called a 2R battle drill. But then you can see we have a high, a lower high, and a third lower high. That is one of our 1, 2, 3 exits, which is another pattern that we have identified. So then we start looking again. After this really strong move, I'm not really looking forward to doing anything on the downside here. So I do have a positive bias. We see our crossing again, our second crossing, our PSAR flip. Boom, I'm back in. Get another high, lower high, lower high. 1, 2, 3 exit. Done for the day. So draw your attention up to here. So what does all that mean? So the symbol was PayPal. I had a minimum manageable risk box of 42 cents. My position size is 200. I don't like to risk on any one position. I don't like to risk more than $100. That's a significant number for me, especially when I'm educating people, and I do teach classes every day. So the position size is 200. And then we measure our trades in R, which is the total delta between the in and the out, divided by the amount of risk I was willing to take on any one position, or any retracement. That's the yellow box here. That's a 42-cent box. So it doesn't really have anything to do with position size. It's just what is statistically, what is the range of this going to be. So my range stat is $4.27, meaning over a specific period that we've developed over time, this thing will move typically $4.27 on average. I'm not allowed to be surprised to see it move that much. 1/10 of that is the minimum manageable risk box, because if it's going to start out low, I'd like to have 10 slices of that. So I make sure that my risk is very low and my return can be pretty high. So very little risk. So each position worked out to be about $84 per position, because I'm never going to take more than 1 R of a loss. So the maximum I could lose is $84, because that's 200 times 42. So by risking this $84 per position size, the gross take on this was $1,482. The net was $1,432 after the round trip tickets. And then max exposure, and when I had all 4 of these going at half an hour risk of retracement, which is our very worst stop, 1, 2, 3 exit got me out just slightly above the half hour limit. So that was the most I ever had exposed, was $164. So it's nearly a 10-to-1 max exposure to net gain. So that's my secret. Happy trading.